Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney, where markets have just come online.
And I'm Paul Allen. We are counting down to Asia's major trading opens. The top stories this hour. Wall Street looks past mixed economic data, with the S&P 500 hitting another all-time high. US retail sales dropped by the most in nearly a year. Jobless claims decline.
Fears of a wider war in the Middle East continue to grow as attacks intensify between Israel and Hezbollah in Lebanon.
Plus, our scoop on how Apple is readying an AI tool for developers that would step up competition with Microsoft. Let's get to some breaking news right off the bat. We do have unemployment numbers out of South Korea. The rate dropping unexpectedly to 3%. The expectation was for a reading of 3.2%. That's a pretty dramatic slowdown on what we saw the month prior as well, although the revised number for December now being brought down to 3.2%. So 3% unemployment rate in South Korea. Interesting story as well. 1 out of 5 jobless seekers or job seekers in South Korea age 60 plus, so that does tell something about the story of the aging population in South Korea as well. We've just opened for trade here in Australia. Meanwhile, let's take a look at how we're doing in the early going. Building on some of the gains that we saw on Thursday, the ASX currently higher by about 1/5%. We do, of course, as you know, have the staggered open in Australia. We open in alphabetical order, but we've got the ASX already trading. We had earnings today for the first half from the ASX. A miss on revenue, a miss on the interim dividend as well. We've got shares in ASX declining by 0.2% at the moment. BHP, meanwhile, gaining. We had the news today that train drivers have called off their strike action at the world's biggest miner. See the yields on the Aussie 3-year and 10-year. Not a lot of movement there. The 10-year currently at 4.157. The Aussie dollar breaking back above 65 cents after yesterday's surprisingly high unemployment read, 65.27 there at the moment. Okay, let's take a look at futures. Meanwhile, for the Nikkei, looks like we're setting up for another positive day there, better by 0.1%. New Zealand already trading. We heard from the RBNZ Governor Adrian Orr a little bit earlier on. He's keeping the inflation fight well and truly alive there. We've got the NZX putting on some modest gains. The yen, meanwhile, that's dropping just below the 150 level, and we are, of course, still on watch for possible intervention from the Ministry of Finance.
Yeah, certainly at those levels is always a risk. But Paul, take a look at how we're setting up for US futures at the moment, looking broadly positive. We did see traders on Wall Street more or less looking past what is a bit of a chaotic and mixed set of economic data. We saw both stocks and bonds in the US high before that inflation reading that will help kind of define where the Fed goes from here. But we did, as we mentioned at the top, both US retail sales and industrial production showing declines. Home builder sentiment, on the other hand, climbing to a 6-month high in February. So a real mixed bag there. We are seeing broad positivity, a little bit more so when it comes to Nasdaq 100 futures, up about 0.25%. We also saw Treasuries ending the Thursday session with just small gains after pairing that advance that was sparked by the softer than expected January retail sales numbers. And with that mixed sort of calendar, in particular with that unexpected jump in import prices ahead of the PPI data due out on Friday, as well as sort of business surveys seeing stronger than expected earnings out of the New York and Philadelphia Fed banks. A lot of sort of mixed messaging for Treasury traders to be dealing with at the moment. We did see demand kind of surging for downside protection when it comes to Treasury options. That re-cheapening of US 10-year yields back towards 4.5%. A quick look at oil as well. We are seeing that rise continuing just above $78 a barrel in New York. The risk-on sentiment across broader markets certainly kind of luring traders back into crude, and that certainly was a bigger kind of story than the IEA's forecast for slowing demand growth, Paul.
Okay, let's get a little bit more on that US data with our global economics correspondent, Enda Curran. So, Enda, as Heidi was saying, there's some real mixed signals there. What's the key takeaway from this retail sales number?
Look, the retail sales number was weak. It's mostly covering merchandise goods. There was weakness there in purchases of gardening equipment, of construction material, electronics purchases were down. On the upside, spending on eating out, spending on groceries was actually up on the month. So it's kind of a mixed picture. It's also hard to completely ignore the fact that it's a month after, of course, the big holiday shopping season, and there was pretty bad weather, heavy snowstorms in the month as well. So there's some seasonal factors going on there. But But, net, you'd have to say at the very least it suggests maybe some softening of consumer sentiment, consumer spending. Some of the big corporations here have been making the point that customers are now putting more emphasis on value rather than perhaps spending and splurging the way they were. So this particular one number doesn't suggest an end to the consumer boom or anything like that, but it might suggest that perhaps consumers are becoming a bit more cautious, and at the margins maybe some steam is coming out of what once were very red-hot parts of the economy.
And when it comes to the labour market, how significant was that drop in jobless claims for you?
Well, this comes out every week. I don't think it changes the overall story today that the jobless claims dip really. If anything, it speaks to, broadly speaking, the labour market is in good order still, Haidi. There's been a lot of high-profile layoffs here. A lot of well-known brand-name companies have been cutting staff, sometimes in sizable numbers, but not yet enough to make a dent on the aggregate overall level. But this, of course, is where the big debate is. We just had those really strong figures for January. You do have some economists making the point that, look, the labour market is softening. Job advertisements in particular have come off the boil. That suggests companies don't want to hire as much as they used to. Some are arguing the next stage, and that will be actual job cuts. We're clearly not there yet. Today's numbers don't necessarily push that story in either direction. I think it's fair to say, for now at least, the jobs market story continues to be pretty robust.
So what does all this mean for the Fed? And you mentioned the retail number might have some seasonal factors there. Is the biggest story here still CPI?
Well, we did also have the industrial data today that you mentioned. That was soft and suggesting the manufacturing sector is still under pressure. And that's kind of going against the grain of what people had been thinking, that there was a bit of a pickup in manufacturing. So, you're getting pockets of softness. You're getting mixed signals on the consumer, as we discussed. Some pockets of weakness in manufacturing. But broadly speaking, the labour market is still strong. And the Fed has made it very clear they're going to be very careful about how they move forward from here. They want to be confident inflation is heading back to the 2% target, and given the strong inflation data that we had earlier in the week, you'd have to say that sense of caution and reticence on their part to signal at least a near-term rate cut will continue until, of course, we get a material shift in the data.
A global economics correspondent, Enda Karan there, with a wrap-up of the slate of data. And let's bring in for some analysis when it comes to what this means for the markets. William Curtain is a portfolio manager at Milford Asset Management. William, always great to have you with us. So pretty messy across the board. You were looking at a number of these data points in terms of how it kind of directs the trajectory from here. Did it change anything for you?
Mixed data, as Enda quite just gave a good summary of that retail sales data. But if we look towards what's happened so far this year, we went into the year with a lot of the markets and commentators and participants very convinced that a recession was coming. The US economy would slow significantly. And of course, we were originally expecting rate cuts to begin in the US in March. The data on aggregate so far this year has been surprisingly resilient or surprisingly strong. Now, it's not every data point. There is mixed reports like the weaker retail sales that could have been somewhat to do with the weather and seasonal effects in January. But there's been a lot of signs that the economy isn't slowing as expected. Jobs reports have been generally pretty robust. CEO confidence has been improving. The ISM manufacturing reports and prices paid by businesses have ticked up. And this keeps, at the moment, pushing out the time of when we expect rate cuts to occur. Now, what we have tonight will likely be the icing on the cake of the recent data we've seen over the last few weeks, and that's the PPI. So given in the context of a hotter than expected core CPI report this week, the PPI is now very important. The ISM prices paid survey from a week or two ago indicates that we might actually see some upwards pressure on the PPI also. So we're very keen to see what that number comes in tonight, because I think it will drive a lot of market direction, obviously, in the final session this week in the US, but also into next week.
If the PPI is in that sort of same trend and hotter than expected, does that reinforce the sort of theme that perhaps we'll see a quicker than expected rotation back into energy resources?
Yeah, that's the risk. One thing to accept is we are in a full-blown bull market in US equities driven by these tech shares. So when you're in a bull market of this magnitude, it can take a surprising amount of contrary news to to drive that rotation out of technology stocks and into something else. I mean, you would have thought in most circumstances the kind of data we've seen on economic strength so far this year would have already driven a rotation into cyclicals, but the earnings have been strong by the big tech companies. The AI themes is very powerful. Fund managers and institutional investors have been sucked into the sector to make sure they participate, and retail, of course, is chasing it as well. So we think a hot PPI report would give a reasonable chance that you'll see continued rotation tonight and next week, like we saw in the session in the US today and overnight, where that rotation started to begin. So, yeah, certainly a very hot number. I think rotation would begin.
Yeah, in terms of that tech rally, though, is it too early to call the end of that? Because we keep getting interesting news flow today from OpenAI, also Bloomberg reporting today that Apple's got new AI developments as well. So even at these elevated prices, is there still a pretty strong temptation to keep adding to your positions?
Oh, exactly. If people have missed out or not participated in it, very hard to dispute that most of the big technology companies reported increasing plans of capex spending on building out their infrastructure for AI. I mean, all of that supports NVIDIA's revenues. So, of course, NVIDIA result out next week is going to be probably the single key thing that will tell us whether, for now, the boom in AI stocks will continue or not. But in the context of all the capex being sent, I'm sure NVIDIA is still seeing a huge amount of demand. So, we wouldn't be betting wholesale against it. In fact, a lot of the earnings growth from many of those Magnificent Seven big stocks are very strong, even and not actually, it doesn't make their PE multiples they're trading on too unreasonable versus the rest of the market. When constructing a portfolio, we would balance out having some of those technology longs by having some of those out of favor sectors like energy or materials or financials, so that if the rotation does begin en masse, at least you'll be winning on some of the stocks that are being rotated into.
William, before we let you go, I just want to quickly get your views on Japan as well. Of course, slipping into a surprise recession yesterday. I'm just wondering if that changes your calculations about what the BOJ does next and your investing approach.
Yeah, Japan's obviously, the Nikkei, been an absolute star performer. A lot going for it, really. A weak currency means that exporters are getting very good earnings growth. The rebuilding of supply chains in different countries around the world for geopolitical sort of reasons creates a lot of demand for these businesses. And in relatively loose monetary conditions versus the rest of the world is all good fuel for this re-rating in this bull market. Now, the challenge we go ahead is whether Japan gets in some kind of stagflationary environment. Inflation, of course, still running near around 3%. If the economy's in a recession, then that's almost what we call stagflation, which many countries around the world are heading into, including where I sit today in New Zealand. If the currency continues to be weak, that's the key thing the BOJ is concerned and trying to push back on now. Now, they'll try to intervene and use certain reserves to prop up that currency. But if that doesn't have sustained impact, it could be the catalyst to force them to go even tighter on monetary policy. And that becomes the headwind for the Japanese market and the great momentum that it's been seeing.
William, quick word on China before we let you go. The bar seems very high for a significant outperformance or rebound there. Are you opportunistic at all?
No, we'll be fast reactors if we see the data turn positive, is probably where I'd put it, and we're watching it closely. For a long time, the markets, consumers in China would always give the benefit of the doubt to the Chinese policymakers that they will stimulate and they will come out of this. Now, given a lack of significant stimulus over the last year, that confidence is gone, not just by market participants, but also the consumer in China is very depressed. We've got deflation and prices. The consumer is saving and is very cautious and not spending. So we think the situation probably is getting weak enough that China will begin to really do some serious stimulus measures. If we see those coming in, if we see that turn, the confidence from the Chinese consumer positive, then it could unleash a huge wave of spending by the Chinese consumer, which would be very bullish for resources, Chinese equities, the sentiment towards China, which is very bearish. But we want to see signs that's occurring before trying to front run it in too big a way.
All right, William Curtain, Portfolio Manager at Milford Asset Management. Thanks so much for joining us. Still to come, traders flock to Japanese equities as stock prices hover within sight of an historic peak reached way back in 1989. We'll have a preview of Japan's market open coming up later. First, though, strikes between Israel and Hezbollah in Lebanon intensify, raising the fear of a wider war. Details next. This is Bloomberg.
Well, fears of a wider war in the Middle East are growing as strikes intensify between Israel and Hezbollah. The group has fired a barrage of rockets in retaliation for the killing of one of their commanders. Let's bring in Bloomberg's Michael Heath. And we've seen really kind of the focus of a more regionalised conflict taking place in Lebanon now.
Yeah, that's exactly right, Haidi. And we've seen this week sort of a ratcheting up of the fighting between Hezbollah and Israel. Obviously, they fought a war earlier this century, which devastated Lebanon, and this is a real concern. I mean, Hezbollah is the most powerful militia in the Middle East. For Israel to then engage them as well, that would really probably signal that we're going to start to see a widening of the conflict sort of thing. At this stage, I think the local press in the Middle East is sort of saying on a scale of 1 to 10, this is only a 1, but because they've always kept it below a certain level of engagement. But it does seem to be grading up. So it's going to be very, very interesting to watch. I mean, obviously, a lot of Israelis have had to be evacuated from that north of the country because of this fighting with Hezbollah. Hezbollah is too close to the border compared to what they were supposed to do under the ceasefire when they last fought. So yeah, it's an issue that is escalating gradually, unfortunately.
Let's talk about what's happening at the other end of the Gaza Strip. Israel says it's arrested Hamas combatants at Nasser Hospital in Khan Yunis, which is not far from Rafah. What more do we know? Yeah,
well, so they've undertaken this raid on the hospital. This is the other major hospital in the enclave, and there's conflicting reports, obviously, about. There's been said to be Al Jazeera is saying that doctors have been injured, and that Israel has been. It hasn't been precise enough in what it's doing here. Now, Israel says it was going in there because it had information that there were that hostages had been held there, and that there were the bodies of hostages. And this is part of the state of Israel's policy of no one left behind. Not only are they trying to get the hostages, they're trying to get the corpses of anyone who has died as well. So far, there's no sign of that. They have said that they've arrested militants, including people who were involved in October 7 in the initial attack on Israel, as well as mortars and grenades. They said mortars had been fired from that area. Now, we know Hamas does shelter among civilians. Israel also says that there's probably tunnels underneath it, like was found in Gaza City. So Hamas does shelter among them, but again, it's a terrible look for Israel. I mean, this is a hospital. We're in a humanitarian crisis. There's not enough medicine. There's a lot of people suffering, and then you've got to raid on a hospital. It really, really doesn't do a lot for their image.
We've also seen key US allies release some pretty strongly worded warnings. Yeah.
I mean, Australia, New Zealand and Canada came out yesterday in a joint statement. Now, the interesting part was just that they don't normally do joint statements, these three countries. And again, just sort of almost demanding a humanitarian ceasefire. And I guess the sense is, and Germany also has spoken out on this, but the sense is that these people are sort of cornered, all these civilians. There's more than 1 million people stuck in this, at the end, as Paul said, of Gaza. There's nowhere for them to go now. And it's almost like it's set up for a massacre, because if those people can't be shifted elsewhere, and where to, Israel can say all it wants that it's only trying to target militants, but the fallout is going to be devastating. We're talking tens of thousands of people who die in this. And that's why there's such opposition growing in the world. And it's going to be difficult for Israel to handle this, definitely.
All right, Bloomberg's Michael Heath. We do have plenty more to come on Daybreak Australia. This is Bloomberg.
Well, the Australian retail demanding conglomerate Wesfarmers remains optimistic when it comes to growth. Despite higher costs putting pressure on consumers and businesses, I spoke with the CEO, Rob Scott, after the company reported first half earnings that beat expectations.
this is a moment in time where obviously households in Australia are doing it pretty tough with inflation, cost of living pressures, and we've worked really hard to ensure that we're offering fantastic value across our very broad range of businesses. Well, we're seeing that consumers are being very discerning about their spend. I'd say at a general level, unemployment is still relatively low, population growth is benefiting retail spend. So there are some positives, but as I said, value really matters. So we're seeing, fortunately, across our businesses, we're seeing growth in customers, growth in transactions, albeit the basket size is a bit smaller given those cost of living pressures. And within our businesses, the standout performance recently was the Kmart business, given the very unique Anko private label product we have.
We did have data this week showing that unemployment, I should say, in Australia is at a 2-year high, and there is cooling when it comes to the labour market. You are Australia's largest private employer, and I do wonder whether you can give some commentary around how you view hiring conditions at the moment.
Well, look, I'd say that generally, Australia is in pretty good shape, but I think there are a few headwinds that we are dealing with. In Australia at the moment, although we've seen inflation come off a bit, there's still a lot of domestic cost pressures that are creating challenges for business. We've got labour costs, power costs, accommodation costs, domestic supply chain and freight is continuing to go up at very high rates. So I think that is one of the major challenges as we look to the year ahead, that if we don't see those domestic cost pressures start to normalise, then inflation may be more persistent. And obviously that will then lead to businesses employing less people, providing fewer hours of work. So I guess that is the risk factor on the year ahead. But it's why we across our businesses are very focused on trying to control what we can control, to keep our costs down, drive productivity, to help our teams be more productive and efficient on their day-to-day roles.
Some of those costs have come down, like international freight costs being one of them. And we have heard from the RBA governor talking around the fact that inflation expectations are coming down and looking pretty well anchored. And, as so the markets are expecting easing from the RBA later this year. How much of a time frame would you allow in terms of the pass-through of some of those cost reductions to the consumer?
Well, across our businesses, we've had good visibility to some of the decreases in costs associated with imported product, the decrease in raw material costs in areas like timber, and also the fairly significant reductions post the COVID inflated container shipping freight rates. And we have flown a lot of that through to our customers in price. But as I said, some of those cost savings are being offset by domestic cost pressures, and that is the challenge we face.
That is Wesfarmers CEO Rob Scott there. Still to come, we're going to take a closer look at Japan's market. Stock prices getting very near an historic peak, which we haven't seen since 1989.
Australia is also partying like it's 1989. Taylor Swift kicks off her Eras tour in Melbourne later on Friday. We'll get all the details next. This is Bloomberg.
My guess is that if we were to use the NBR's more holistic definition of what's a recession, I'm not sure the UK would qualify. I'm not sure that Japan would qualify, because one key ingredient which is missing is the reaction of the labour market.
AXA Investment Chief Economist Gilles Moek there speaking about Japan's economy unexpectedly slipping into a recession. I'll take a look at how we're setting up as we take a look at Nikkei futures looking pretty positive at the moment. This, of course, potentially a bit of a game changer, or at least a head scratcher for the Bank of Japan, right, in terms of picking that perfect timing to exit negative rate strategy and put through that first rate hike. And of course, the weakness that we continue to see in the yen is also a part of that conundrum as well. Having said that, we see some pullback when it comes to the US dollar. Of course, a bit of caution going into the PPI numbers today as well, and we're seeing dollar yen sitting under that 150 level. Let's bring in our Asia equities reporter for more when it comes to trading in Japan. Winnie Su joins us. So the rally this year obviously stand out. Japan and Korea are probably the two standout. We're again about 2% away from that 1989 high. Is there a sense that we'll see the momentum to get there?
Yeah, we're getting actually pretty close, and I think a couple different drivers. One of it being really the inflation part, right? Even with the pretty weak GDP yesterday, the market seems to have already kind of looked past that and focus on the fact that Japan seems to be exiting deflation at the moment. And also macro-wise, you have a pretty strong U.S. market, and also the weakness in China is still continuing, which makes it which makes Japan a more favorable market. But also when you just look at the fundamental sides of things, earnings seems to be pretty strong, as we can see from the earnings season this time. And also the TSE reform, a lot of people citing this to be one of the key major factor for Japanese rally to be so strong. And I think from a flow perspective, it's also pretty supportive. We've seen foreign investors buying 5 weeks of Japanese stocks straight, and we're also waiting for the latest data later today.
Well, when you're heading into the end of last year, we had a number of commentators saying, well, maybe we're setting up for a correction here. It hasn't materialized. Have some investors been caught by surprise by this momentum?
Yes, absolutely. Just yesterday, we saw Citi raising their target for topics and Nikkei. And also just in the past couple weeks, you see JP Morgan coming in and Morgan Stanley and also Bank of America all raising their targets. So it seems like this rally is really catching some investors by surprise. But we did caution, last year that there might be a potential appreciation of the yen weighing on the market. But when you see the Fed more unlikely to cut rates at the moment, and also the Bank of Japan maintaining a relatively dovish, accommodative monetary policy at the moment, it seems to be still supporting the rally going forward.
How's earnings shaping up?
Yeah, we're right now nearing the end of the earnings season. I would say overall it's quite positive. We see more earnings beat than miss, but also we're seeing pretty big share price reactions around the earnings, a lot of volatility. And some people say that that might be caused by some of the newer foreign investors coming into the market, trying to join the rally, but still trying to get a hold of what's going on in the Japanese market. But we did see really a lot of some of the good earnings results from major Japanese companies, from Toyota, from SoftBank, and the other day we had Tokyo Electron also hitting record high after revising their earnings. So those positive earnings actually provided a new catalyst for the rally this time.
Our Asia Equities reporter Winnie Su. Well, speaking of 1989, Taylor Swift kicks off the Australian leg of her Eras tour later on Friday with the first of her 7 shows across Melbourne and Sydney. The highly anticipated concert could generate as much as 1.2 billion Aussie dollars in economic value in Melbourne alone. Our economics reporter Swati Pandey joins us now from Sydney. Highly anticipated seems like a wild understatement, right? And Melbourne in particular expected to be her biggest show yet.
Yes, I was surprised to see that number, $1.2 billion, which is coming from the mayor of Melbourne. It includes everything, indirect benefits as well, from people flying in from overseas, hotels, flight tickets, spending while they are in Melbourne. So nobody's going to just come in, fly in for those few hours and go back. So people are kind of making a little holiday around it. So the economic benefit that includes everything just in Melbourne is 1.2 billion. We don't have a figure for Australia-wide, but it's definitely going to be big, and economists and RBA will be keeping an eye out as well.
Yeah. To your point, even the RBA Governor, Michelle Bullock, noted the impact of this concert, even in an anecdotal sense. But it speaks to something broader, doesn't it? She talks about her children not spending on other things, so they can spend on this. So what are the implications there?
Yes, that is, I guess that is what we are going to see. From chatting with economists, it looks like this is going to be a sugar rush where people will spend around this time, whether it's those bead bracelets or sequin dresses. But then later in the year, we are going to see the cutbacks because look, the economic condition is getting tighter with interest rates at 12-year high, expected to remain there, and other issues like property prices, rents, electricity. So people are feeling the pinch, and while they are going to spend here, there will be cutbacks later.
All right, economics reporter Swati Pandey there. Now, Seoul is set to host one of the most hotly anticipated Major League Baseball season openers next month. Bloomberg's David Ingles spoke with the city's mayor, Oh Si-hun, about how he's looking to make MLB games regular events in South Korea.
This is the Gochok Skydome. Things are quiet now, but in a few weeks, Major League Baseball season will kick off in Seoul, of all places. It will be the LA Dodgers' debut of their $700 million man, Shohei Ohtani, as they face off for 2 games versus the San Diego Padres. And according to Oh Se-hun, the mayor of Seoul, there are plans for Korea to host more MLB games in the future, but he's aware that the city's infrastructure does need an upgrade.
Seoul has the only dome stadium in Korea. It's a small to medium-sized dome stadium that seats about 20,000 people, but it's a very popular venue. It was built about 10 years ago and needs some repairs. We are currently spending a considerable amount of money on renovations.
The mayor says the South Korean capital is preparing itself to host bigger events for more people.
The Sports Mice Complex in Chamsil, the sports facility that hosted the 1988 Seoul Olympics, is undergoing extensive renovation. There are plans to build a new dome stadium that can accommodate about 30,000 people.
Seoul wants to see 30 million tourists descend on the city annually. And with the lure of K-culture, these big sporting events, music, art, F&B festivals, officials are confident that number is actually within reach.
The big question remains, though, where will everyone stay? Seoul does not have enough hotel rooms currently to house those kinds of big numbers. So unless authorities are able to take that issue and pull off a makeover as thorough as some of the city's medical clinics do on a daily basis, they'll probably need to find a more creative solution to house those incoming tourists.
Korea is not a country where Airbnb is active. Policy-based deterrence measures have been implemented. If the number of tourists increases rapidly, a significant number of tourists can be accepted through Airbnb alone if policy regulations are improved. As the government has set its goal of receiving a large number of tourists, deregulation policies are being reviewed under the new administration.
As for seeing Ohtani in person, tickets for the first game were sold out in an hour. Seats for the second go on sale in March. In Seoul, David Ingles, Bloomberg News.
You can watch us live and see our past interviews on our interactive TV function, TV Go. And there you can also dive into any of the securities or Bloomberg functions that we talk about. And you can also become part of the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. You can check it out at TV Go. This is Bloomberg. You're watching Daybreak Australia. OpenAI has teased a new AI system that can create realistic-looking videos based on text prompts from users. The system, called Sora, can quickly create videos up to a minute long. On X, OpenAI CEO Sam Altman wrote the tool will initially be made available to a limited number of creators. Staying on AI, and Apple's nearing the completion of an artificial intelligence tool for app developers that would step up its competition with Microsoft. For more, our technology reporter Mark Gurman joins us. Mark, we did see Apple stock pop on the publication of your story. Apple often late to these sorts of parties, but often with quite a good product as well.
This is the year of generative AI, not only for all the big tech companies, Amazon, Google, OpenAI, but Apple especially. That is the focal point of their software development, their services development for 2024. In June, you'll see them make their big generative AI related set of announcements. Now, as core to any is a new version of Xcode. Xcode is their flagship programming software that allows Apple, but also third-party developers, to write their software, right? And so this software is going to integrate generative AI in order to use large language models and other artificial intelligence and machine learning technologies to help developers write code, to predict the code, to fix their code, to test their code. So this is a major effort for the underlying infrastructure that's going to power all sorts of new applications into the future.
Mark, we know that Apple tends to be a trendsetter, but in this case, they're playing catch-up, right? How urgent is this need for an AI strategy and investment, and how, difficult is the competition going to be for Apple?
Apple is definitely playing catch-up here in artificial intelligence. They were essentially caught flat-footed by ChatGPT and the efforts from OpenAI. They are very much behind, but they're going to be operating a little bit differently. They're trying to operate from a position of strength here. They have their own underlying large language model, their generative AI system. The software side of that is codenamed Ajax. We wrote about it last July. But at this point, what they're looking at is not chatbots. They're looking to apply that Gen AI tech to applications. You can imagine a new version of their web browser that can auto-summarize articles. You can imagine a keyboard that could better predict what you want to type next based on who you're communicating with. You can understand there'll be more augmented reality functions powered by artificial intelligence across their product lines as well, up to the Vision Pro, down to the Apple Watch. So I think there's definitely a lot to like from what Apple's position is going to be, no matter how late it is. In terms of when we're going to start being able to live and breathe this stuff, I would anticipate some beta releases for the developer community and those in the public who really want to get their hands dirty with this type of stuff sometime in June, and then it'll be released to end consumers before the end of the year.
Another great scoop there. Mark Gurman, our Bloomberg technology reporter. Well, Australia is moving closer to mandatory restrictions on AI usage. The government has named a panel of experts to advise on the potential guardrails for the development and use of AI.
And our next guest is one of the 12 experts in that group. Joining us now is Jeannie Patterson, Professor of Law and Director of Centre for AI and Digital Ethics at the University of Melbourne. Jeannie, thanks so much for joining us. I just wonder, to get us started, can you give us a background on the state of the current regulatory framework around AI in Australia? Where are the holes? Where are the risks?
Well, we don't have a regulatory framework for AI in Australia that's specifically aimed at AI. What we have is general law. Now, that general law can do a good job on most things, but AI is developing so quickly, it's so ubiquitous that it's felt we may need some guardrails, particularly in relation to things like deepfake frauds, misinformation, disinformation. We want to have guardrails against those harmful uses so that we can benefit from the opportunities that AI does offer a society.
Yeah, well, to your point on the ability to create misinformation, you might have heard us report a moment ago on OpenAI's new product, Sora. This will convert a text prompt to a 1-minute video. You don't need to have much of an imagination to see where that could take you. How do regulators keep up with this sort of technology?
Well, that's precisely the purpose of the expert group that's been gathered together to advise the government on where those harder guardrails are needed to protect us. Now, some of the solution is in law, but some of the solution also is in the technology itself. It's possible, and indeed I think essential, that we're looking at how tech developers and those who apply the technology can build in safeguards against the misuse of this technology to cause harm to society, individuals and democracy itself.
Jeannie, it's hard to see how regulatory and legal frameworks can keep up with the speed of the development of the technology and the ability that it's being used for ways that, as Paul mentioned, we probably can't even imagine right now. Do you think that this is an area where regulators will always be trying to play catch up?
I'm optimistic in the ability of regulators to respond to technologies, and that's because what we are looking at is a combination of responses, not just one law that will fix these problems, but a whole suite of social responses that go from education, so people understand the technology more, to these technical safeguards that I'm talking about. There's been a lot of talk about watermarking, for example, right through to mandatory laws that put specific obligations on developers and those who use the technology. So I think a coordinated response is possible and available to us if we act now.
That seems to suggest that that requires a truly coordinated response and coordinated regulatory and legal frameworks across various sectors, right? Do you envisage a situation where we'll see specific legislation covering protection of children and AI usage, for example, healthcare and other industries? And how difficult is it to get buy-in from all these various parts of the economy and society?
Well, I think that's part of the job of the expert group, in fact, is to make sure that those voices from the different part of the economies are heard and that we understand the responses that are necessary. And you're quite right, this is a coordinating effort. We already have steps in place to protect children through the E-Safety Commissioner, and the question is how we find the gaps in that regime to ensure that we've got good safeguards. And similarly in the medical field, the medical field is working very hard to utilise the best of AI. So it's about coordinating with them to work out where they need assistance actually to promote innovation and where they need protections against uses that are problematic. And I'd actually say one of the big challenges with the increasing reliance on AI is actually cybersecurity and hacks. And that's something we also need to be very aware of.
Now, for various reasons, the year 1989's been pretty steady in the news flow today, but that was also around about the time that the internet was just gaining steam. So if you look back at that period of history, are there any useful guidelines from the development of the internet that you can apply to the regulation of AI technology?
I think the lesson we learned from the internet is that we need to act early, but be adaptive. There were lots of suggestions about what was going to happen to the internet and whether it was going to be a benefit or a negative, and I think we can say it's probably both. The regulation needs to be open-ended and flexible enough so we don't stifle innovation, but it needs to be able to respond to those harms I've mentioned, and in particular disinformation, misinformation, cyber fraud, really. And the other comment I'd make is the thing we learned from the internet is it's dangerous to predict too far into the future. So this is an ongoing conversation that we need to have.
Very quickly, many in the industry would prefer voluntary safeguards, self-regulation. Is that going to be enough?
That's, again, one of the things that this committee is talking about. I'd have to say that I think that voluntary safeguards have a place, but I think the general feeling in the community is that voluntary safeguards may not be enough, and we need these other kinds of guardrails put in place, along with, and I'll repeat this again and again, information, so people understand, information education, so people understand this technology and can take their own decisions about how they interact with it and the precautions they themselves take to keep themselves safe.
Jeannie Patterson, Professor of Law and Director of the Centre for AI and Digital Ethics at the University of Melbourne. It's a pleasure to have you on with us. More ahead here on Daybreak Australia. This is Bloomberg. You're watching Daybreak Australia. The top corporate stories that we're following today. Jeff Bezos has unloaded another 12 million shares of Amazon valued at $2 billion, bringing the total sold in the past week to over $6 billion. He'd earlier disclosed plans to sell as many as 50 million Amazon shares. The sales also come as he recently relocated to Florida from Seattle, a move which could save Bezos millions in taxes. The US Justice Department plans to scrutinise the new streaming service proposed by Walt Disney, Fox and Warner Brothers Discovery. That's amid concerns it could harm consumers, media rivals and sports leagues. Sources say regulators will look at the terms of the joint venture once it's finalised. Disney, Fox and Discovery announced a new streaming service earlier this month. General Motors is mulling a shift from mainstream models in China by focusing primarily on luxury vehicles. The car maker is struggling to bounce back from years of declining sales and profits in the world's largest car market. A narrower product strategy in China would mark a big reversal for GM, which entered that market in 1997. Ford Chief Financial Officer John Lawler says a smaller, cheaper electric vehicle should be available in a couple of years. The firm is looking to ramp up its development in the face of low-cost Chinese EVs. The car maker was hit by multiple setbacks recently, including strikes at some of its factories.
We are developing a low-cost EV platform so that we can be a big part of this S-curve when it comes time. And that is, I think, coming in a couple years from now, and I think it's going to be a big inflection point for the industry when more affordable EVs come online.
Just getting some breaking news across the Bloomberg terminal at the moment. We're hearing from the Atlanta Fed President Raphael Bostic. He's been saying that it might take some time to be sure that inflation is heading back to 2%. Bostic saying victory not clearly in hand. We're not done with inflation, and there is a risk that a new demand burst could reverse the progress that has been seen so far. So he's saying the Fed needs to see more evidence that inflation is headed sustainably towards 2%. Inflation is expected to fall, but much more slowly than the markets are anticipating. Bostic also saying there is no urgency to cut, with the labour market strong and the economy looking strong as well. So the Atlanta Fed President Raphael Bostic making those remarks there. May take some time to be sure that inflation is heading to 2%. All right, we're going to leave that there. Bloomberg subscribers, though, can continue watching at Live Go. You'll also find the big diary entries coming up today and later on this week as well as some of the events you might have missed earlier. Market opens in Seoul and Tokyo next. This is Bloomberg.